Good morning, everyone. And inflation in the US through the roof, 5.4%, horrible number. Central banks are way behind the curve, way behind the wave of inflation. Inflation is a massive problem for the world now. It's at critical crisis levels for the United States and will be for Australia as well, and every country around the world, as every business seizes the opportunity to increase their profit margins through raising prices. This is a psychological phenomenon at every level of business management that is unstoppable at this stage. So inflation is going to remain high, get higher, be a problem for a long time. And all those people who are trying to discount it as transitory, egg on face in the future at some point, seriously. Central banks behind the curve means that they'll be raising rates in an aggressive way too late in the cycle, which means they'll have to do even more rate hikes than they otherwise would have had to do. So we really are at a point where the inflation ship has sailed. It can't be brought back to harbour. So what does that mean for stock valuations, stock prices? Well, initially, as I said yesterday, it's actually good for corporate earnings because it's all about increasing profit margins. But further down the track, it's decimating for the economy. And with the central bank rate having to juggle, does it raise interest? I'm talking about the US Federal Reserve, I'm talking about the RBA, I'm talking about most OECD central banks. Having to think about raising rates when the economies aren't doing as well is a diabolical situation. That's where we are headed. In price action and stocks in New York, we saw the NASDAQ initially fall about 120, 130 points, and then it rallied an incredible 250 points, and then it's fallen back down again. The Dow Jones never made a new high and looks very heavy. The S&P 500 made a new high and then retraced and also looks very, very, can I use the word sick? It looks sick, and not in that new popular way of saying it looks sick as in great. No, it looks sick as in sick. So the Australian market just stayed in its range the last few weeks, and I put out a report last week saying the Australian stock market is at the brink of collapse, and I'm sticking to that because basically it hasn't broken the top of that range, and while the US stock market's been making record highs, the Australian markets remain heavy. Starts to subside again, as it should, given the extension of the lockdown. We were the first to say the lockdown could be for 2 months, and it looks like it could be in Sydney, and perhaps getting greater in terms of regions and areas. So, plus the stimulus cliff that's just ahead of us in terms of stimulus starting to run out. But then, of course, because we have shutdown, the Prime Minister has brought in another new stimulus package. So again, Australia borrowing from the future to feel good about ourselves. Now it's becoming a big problem. Debt is going to be a problem. Inflation is going to be a problem. It's getting to be between a rock and a hard place, or between a rock and the ocean. It's a difficult economic outlook over the next 1 to 2 years, far more challenging and difficult to navigate than many a commentator and central bank had hoped would be the case. The idea that inflation is transitory is completely false, should be thrown out the window, thrown deep into the ocean. I keep using those references. But I really want to impress on people today and moving forward for quite a long time now that the economic reality is nowhere near what stock prices are pricing in. I mean, in the US, they're pricing in a nirvana economy that's already 30% or more bigger than it was in 2019, when it hasn't even got back in absolute terms to 2019 levels, with over 30% of annual GDP stimulus having been pumped into it. This is not a healthy economy. Unemployment is still strong. But I've talked about divergent economics before, where some companies, some sections of the community can do extremely well at the moment, but there's a divergence between those who are not doing so well and the increased marginalization of some areas of the community. These are things that will become more serious problems over the long term. In the short term, we have a situation where the economic data is screaming that we have problems ahead. Everyone's trying to look past it and ignore it. Look past it has been such a theme of the last 12 months. Look past the troubles. But I think that's starting to run thin. And we do have a situation where inflation in the US came in at 5.4%. Core inflation was 4.5%. That's the number the Fed likes to look at. Tapering has to happen now, at least the start of tapering, and the Fed has to look at interest rate hikes late this year or early next year. I'm still forecasting a Fed rate hike in the first half of next year, perhaps the first quarter. We're way more aggressive than most people. We tend to say it first at ACY Economics. That's how we add value. We don't always get it right, but we're always looking further out than most people are, and we apply common sense. I call what we do look out the window economics. We look out the window, we get out in the real world, and we apply common sense to what's going on. And at the moment, that inflation situation is a mega problem, and it's now out of control and rampant, and it's way too late for central banks to bring it under control. I think I've already said that to you, so I'm going to wrap up for today. I do like selling the Australian dollar. I do like buying the US dollar against euro and sterling. I do like buying gold for a good medium term to long term trade. I think it could be building to go higher. I think it could become the real hedge against economic uncertainty going forward. Do not like Bitcoin. I haven't liked Bitcoin all the way down. I still don't like it. I don't like Afterpay. I haven't liked it all the way down. I still don't like it. But coming back to that NASDAQ chart, if you want to do a trade on the day, it would be probably to think about lightening some of your your tech stocks. Although the alternative trade is if the NASDAQ can get back above 14,935, that might suggest that we're still in this world of stocks just go up regardless of what actually is happening. So that's that pivot point on the day, 14,935 in the NASDAQ. If we get back above there for any reason, at the moment it looks like we're just going to drop away. That's my most likely scenario. Stocks are going to fall away from here. But if we get back above 14,935 in the NASDAQ, then the idea that there's just too much money in the world and basically it doesn't matter what's happening to the broad economy, stocks are going to go up anyway, or at least tech stocks, the NASDAQ. So 14,935. I'd rather be short with a stop above there, but see how you feel about all that. But there's certainly something in the price action on the day. The volatility is just becoming extreme, the intraday volatility in the US market. I'm sure it's a warning, a real warning signal that something is fundamentally amiss, or that simply the buying power is beginning to diminish. There are more people willing to sell, but it's just a very volatile battle between those forces at the moment. I strongly suggest caution on stocks, long gold, short Australian dollars. Maybe some gold miners in Australia could do well on an Aussie gold basis. So there's still strong spots around the world in terms of economic growth, but it's not as strong as stocks had priced. And I've probably said that enough to you today. Thank you very much for listening in. Clifford Bennett, Chief Economist, ACY Securities, where we say it first on economic outlook. Thank you very much.